What's going on, everybody? Elevate Investment Group here today, and I'm going to give a quick 6-step guide, otherwise known as a napkin investing guide, on the route to becoming a passive investor. Now, it's called a napkin investing guide because it's supposed to be very simple, something you can just hold on to without going through much analysis. So you want to be a passive investor, this is the best way to do it. First step you got to do is clean up and understand your finances. You'd be very surprised as to the amount of people who don't really know how much they're making or how much they're spending on a period-to-period basis. I think it's best to look at your income and your expenses the exact same way a corporation looks at its income and its expenses. First, it looks at its revenue, which is top line. This would be your earnings, and then step by step it goes through all the things it's had to spend money on to stay alive as a corporation. You essentially need to do the same thing. Do you have rent to pay, your leisurely expenses and entertainment, and then as well as your utilities? Look at how much you're making. The first step is to see how much you're making, and the second step is to see where money is going out. Once you have these two things understood, you can rectify any leakages that you deem unnecessary. The next step is to identify a few investments you want to consistently contribute to. These for the most part should be passive index funds. I have made a video on index funds and ETFs, and I will provide the link. But essentially, because you want to take the passive route, you are not interested in what one single company is doing, because that would mean you'd have to monitor what that single company is doing. Monitoring any company in the stock market requires a lot of analysis and often a lot of work. What's best about the index funds is you have a low cost expense ratio, and you have an investment product that essentially mimics the performance of a basket of companies, often a very broad basket of companies such as the S&P 500. Now that you know how much money you're making, where your expenses lie, and you've identified which investment vehicle to go with, next step is making a contribution plan. Now you have to be very realistic on how you want to set up your contribution plan. I've heard of people who have this sudden surge of motivation to build their savings, and they often take very extreme measures that for the most part are not sustainable. You want to have a sustainable plan, and you want to make consistent contributions, probably on a month-to-month basis. The whole point about making a consistent contribution plan is you are not too concerned with whether the market is up or whether the market is down. This is also known as dollar cost averaging. What that simply means is you have a fixed amount of money that you contribute to your investments every single period. By doing this, you are automatically buying more investments during the low periods and fewer during the high periods, which when dilutes into the average price makes you more profitable. To understand how this works, think about it like this. If the amount of money you have is fixed and the only thing that's moving in price is the investment product, by the simple virtue of how much you have, you are automatically able to buy more when the share prices are lower, and you are automatically buying less when the share prices are higher. This is called dollar cost averaging because when your time horizon expands, but by simply keeping the amount of money you contribute fixed, you're automatically engaging in the most profitable strategy on Wall Street, and that's to buy low and sell high. And the reason you're doing this is because when it's at highs, you have less that you can afford, and when it's at lows, you have more you can afford. And the thing with these index funds is they pay dividends. So one thing you want to do when you have your earnings is you want to reinvest them. If possible, you want to engage in a dividend reinvestment program, which is essentially where your cash dividends are converted to more shares without the cost of commissions. Over time, if you keep receiving dividends and that dividend amount accumulates and grows bigger, that will keep being converted into more shares. Those shares that were once supposed to be dividends also start paying dividends. This is essentially an exponential growth strategy. As your dividends start being converted into more shares, as your share base continues to rise, those shares that you once never owned start paying dividends, and it's a continuous process and cycle. So you want to reinvest your earnings whenever you get the chance. You often can inquire and sign up for a dividend reinvestment program directly through your broker or through the institution that manages the ETF, such as SPDR or Vanguard or Fidelity, which are three big ones. Number 5, which is also a very important one, is stick to the plan. Do not withdraw your money as soon as you start seeing some green, because with this strategy, you want to have a long-term horizon. The S&P 500 gives an average return of 8 to 9%. This is backed by almost a century of data. Because the returns on this index are so consistent, you want to make sure that you keep your money there for as long as you can. This often requires a lot of discipline and practice. The last thing you want to do is have an investment strategy that you so successfully commit to, and then lose sight, get off track, and use that to buy a car or anything else that's not necessary. So stay on track, keep your time horizon long, and only take out money if it's absolutely necessary. And the last step, and this one's my favorite, is take a step back and relax. The beautiful thing about a passive investment strategy is you don't need to worry about what's going on in the markets on a short-term basis. Day-to-day fluctuations do not matter whatsoever. It is not an exaggeration to say the passive investor only really needs to look at his investment portfolio once a month, once a quarter, or even a couple of times a year. And that's just to have an idea of where you are, so that financial snapshot can aid you in other parts of life, knowing you have that structure. So thanks so much for listening, guys. If you have any questions or comments, please shoot, and I hope you guys have a good one.